Most retail Forex traders think fundamentals don't matter because price keeps moving without them. You can open a chart, draw a few lines, see a signal, take a trade, and sometimes it works. That creates a dangerous illusion that price moves because of patterns, not because of forces underneath it. Here's the uncomfortable truth. Price doesn't move randomly. It moves because money flows from one currency to another, and money flows for reasons. Retail traders avoid fundamentals not because they're useless, but because they're misunderstood. Most traders try to use fundamentals as a timing tool. They wait for inflation or interest rates or a central bank decision and then ask a simple question: should I buy or sell right now? That's the mistake. Fundamentals are not about timing. They are about direction. They define the environment you're trading in, not the exact moment you click the button. Charts tell you when to act. Fundamentals tell you whether acting even makes sense. If you ignore that distinction, you end up fighting the market without realizing it. This is why so many technically perfect trades fail. The entry looks clean, the risk reward is fine, the setup is textbook, but the trade is pointing straight into a fundamental headwind. Professionals don't use fundamentals to predict the next candle. They use them to answer a much bigger question: which currency should be owned and which one should be avoided. Take interest rates. Not the number itself, but the direction. If one central bank is tightening and another is cutting, that creates pressure that lasts weeks or months. You don't need to predict the exact move, you just need to stop trading against it. Now layer in risk behavior. When markets are calm and confident, money flows into growth-sensitive currencies. When fear rises, money runs towards safety. That shift happens long before your indicator flashes a signal. Retail traders often say fundamentals are slow. In reality, they're already priced in before you notice. By the time price reaches your support or resistance level, the macro decision has usually been made. This is why fundamentals feel invisible. They've already done their work. Think of fundamentals like gravity. You don't see it, but you definitely feel it when you jump off a building. The practical way to use fundamentals is simple. You're not trying to forecast every move. You're trying to stack the odds. First, decide the regime. Are rates rising or falling? Is growth accelerating or slowing? Is the market in risk on or risk off mode? That alone removes half your bad trades. Second, define bias. If one economy is strengthening and another is weakening, you don't need to be clever. You look for opportunities in the direction of that imbalance. Only then do charts matter. Now, technical analysis becomes a tool for execution, not prediction. You're no longer asking the chart where price might go. You're asking where you can get involved with least risk. This is the shift retail traders miss. Without fundamentals, every trade feels equal. With fundamentals, some trades are simply off limits. That's not complexity, that's clarity. Fundamental analysis isn't about memorizing data or reading economic reports all day. It's about understanding what environment you're trading in, so you stop blaming yourself for losses that were structurally stacked against you. When you stop using fundamentals to guess the future and start using them to frame the present, trading becomes calmer, more selective, and more professional. You don't need more indicators, you need context. And once you have it, the chart finally starts to make sense.